In less than 3 minutes, let's talk about securities-based lines of credit, or SBLOC. SBLOCs are loans that stock market investors use to access extra cash by borrowing against the assets in their investment portfolio without having to liquidate the securities. You can think of an SBLOC like the HELOC, which is the home equity line of credit. A HELOC is when you use your home equity as a collateral to borrow cash. They're basically the same concept. Make sure you don't confuse SBLOCs with margin lending. Margin lending is where you borrow against the value of your portfolio and purchase additional securities. You can use a margin loan to purchase securities, but you cannot with a SBLOC. SBLOCs are also not the same as the 401k loan. With the 401k loan, you actually borrow the value of your 401k and then pay it back with a fixed payment plan with interest. The balance of your 401k will be reduced when you borrow it, but with SBLOC, the total value remains the same. The advantage of a SBLOC is you can negotiate for a lower interest rate depending on the amount you borrow. The interest rates are lower if you have a larger portfolio. This is what the super rich people do, is to create a line of credit against their assets without selling any of their stocks, and this is their way to avoid paying the capital gains tax while their portfolio continues to grow. Keep in mind that these types of loans carry some significant risks, so you need to understand them before you borrow against your assets. If the value of your portfolio drops, like when the stock market tanked in March and April 2020, then you could potentially get a collateral call or something similar to a margin call. What this means is the financial institution could force you to deposit more cash to cover the loss of your portfolio value, and if you don't deposit additional cash for the collateral call, then your institution could force sell your securities at a loss. Let me give you an example of an SBLOC. Again, this is not the same as a margin loan or a 401k loan, and I would not open an SBLOC under my retirement accounts because I could face certain IRS penalties if I ever got a collateral call. So first, you need to make sure your brokerage firm offers SBLOCs, and SBLOCs are usually for high net worth individuals, but anyone can really apply for it if you meet the requirements. Let's say you have $1 million in your taxable brokerage account. Because of the market volatility, the brokerage account won't give you a dollar for dollar loan, and they might offer up to 60 or 70% of the portfolio value as collateral. Once you have an SBLOC in place, you can access your funds within a few days. Even if you don't need it right away, it basically becomes your personal ATM, so you can withdraw cash whenever you need it. Repayment is also flexible as long as the collateral value is maintained. Always remember, when you take out any type of debt, you don't bite off more than you can chew. Make sure you understand the threshold of your portfolio value before you get a potential collateral call. Thanks for watching. Don't forget to check out these two 3-minute videos as well as the new fire video coming out tomorrow, Sunday at 9 a.m. Have a good one.
Thanks for watching. Don't forget to hit the like button and subscribe for more fire videos.